Right now, as you're watching this video, 3 companies you probably can't name own a piece of nearly everything you can name. Apple, ExxonMobil, your local grocery chain, the pharmaceutical company that made your last prescription, the bank that holds your mortgage, the foreign government bonds funding entire nations. These 3 firms don't make products. They don't innovate. They don't even have that many employees compared to the giants they control. What they do is own. And the amount they own is so large that if you tried to visualize it, the number breaks your brain before you finish reading it. We're talking about roughly $20 trillion in combined assets under management. That's not a typo. 20 trillion. With a T. To put that in perspective, that's larger than the entire economy of China. It's more than the GDP of every country in the European Union combined. It's double the annual economic output of Japan. And it's all controlled by 3 companies whose names you might have heard once or twice, but never really thought about. BlackRock, Vanguard, State Street. If you just said wait, I've heard of BlackRock, congratulations. You're already ahead of 90% of people. But if I asked you what they actually do, you'd probably guess something vague like investments or hedge fund stuff. Close. But not quite. Because what these 3 firms actually do is weirder, quieter, and far more powerful than running a hedge fund. They are the largest shareholders in almost every major corporation on Earth. They vote on behalf of millions of people who don't even know they're voting. They shape corporate policy, executive compensation, mergers, acquisitions, and business strategy at the highest levels of global capitalism. And here's the kicker, most of the money they control isn't even theirs. It's yours. Well, yours and everyone else's who has a retirement account, a pension, or a mutual fund. So the question isn't just how did 3 companies end up controlling this much wealth? The question is, how did we hand it to them, and what does it mean now that they have it? Let's find out. First, let's get one thing straight. BlackRock, Vanguard, and State Street aren't villains in a movie. They're not part of some secret cabal meeting in a dimly lit room deciding the fate of humanity. They're asset managers. That sounds boring. It is boring. But boring doesn't mean powerless. An asset manager is a company that takes your money, pools it with everyone else's money, and invests it on your behalf. You've probably done this without even realizing it. If you've ever put money into a 401k, you've likely hired an asset manager. If you own shares in an index fund tracking the S&P 500, same thing. If your pension fund is managed by a third party, that's an asset manager too. Now, asset management has been around for decades. But what happened over the last 40 years is that it became massive. Then it became dominant. And then it became so concentrated at the top that 3 firms now manage more money than the next 10 competitors combined. How did that happen?
It starts in the 1970s. Before then, most Americans didn't invest in the stock market. Stocks were for the rich. Pensions were provided by your employer. Social Security handled the rest. Retirement planning wasn't something ordinary people stressed about because the system, however flawed, was more or less handled for you. Then, everything changed. In 1974, Congress passed a law called ERISA, which, among other things, created something called the 401k. At the time, it was a footnote, a tax loophole designed to let executives defer income. But companies quickly realized they could use it to shift the burden of retirement savings from themselves to their employees. Instead of promising you a pension, they'd give you a 401k and say, good luck. This was a massive transfer of financial risk from institutions to individuals. And it had a side effect nobody predicted. It turned millions of average people into stock market investors overnight. Suddenly, Teachers, nurses, plumbers, and office workers were picking mutual funds and trying to figure out what large-cap growth meant. Most people had no idea what they were doing. Enter the index fund.
In 1975, a man named John Bogle did something the finance world thought was insane. He launched the first index fund available to ordinary investors. The concept was simple. Instead of trying to pick winning stocks, just buy a little bit of everything. Track the market. Don't try to beat it. Accept average returns and keep fees low. Wall Street hated this idea. If everyone just bought index funds, what would happen to all the highly paid analysts and fund managers trying to outsmart the market? Bogle didn't care. He founded a company called Vanguard and built it on a radical premise. The company would be owned by the funds, which were owned by the investors. No external shareholders. No profit motive beyond serving clients. It worked. Index funds exploded in popularity. They were cheap, simple, and transparent. And over time, they consistently outperformed the majority of actively managed funds. By the 1990s, Vanguard was a giant. But they weren't alone. State Street had launched its own index fund in 1993, the SPDR S&P 500 ETF, which became one of the most traded securities in the world. And then there was BlackRock. BlackRock started in 1988 as a bond trading firm, but its real breakthrough came in the 2000s when it developed a piece of software called Aladdin. Aladdin is a risk management platform. It analyzes portfolios, models financial scenarios, tracks assets in real time, and helps institutions make decisions about trillions of dollars. Today, Aladdin is used by more than 200 institutions worldwide, managing over $21 trillion in assets. That means BlackRock doesn't just manage money. It also provides the infrastructure that other investors use to manage their money. It's the plumbing and the water. So by the 2010s, you had three firms, each with slightly different models, all riding the same wave: the financialization of retirement, the rise of passive investing, and the consolidation of global capital into fewer and fewer hands. And then came the financial crisis. When Lehman Brothers collapsed in 2008 and the global financial system nearly imploded, governments around the world had to make a choice: let the system burn or intervene. They intervened. Central banks slashed interest rates to zero. They injected trillions of dollars into the economy through quantitative easing. They bought bonds, propped up banks, and flooded the market with liquidity. And where did all that money go? Into assets or stocks. Bonds. Real estate. Anything that could generate a return in a world where saving accounts paid nothing. Investors poured money into the market. And because index funds were the easiest, cheapest way to invest, they poured money into BlackRock, Vanguard, and State Street. Between 2008 and 2020, these three firms more than doubled their assets under management. By 2020, they controlled over $15 trillion. By 2023, over $20 trillion. And it's still growing. But here's where it gets strange. Because they're passive investors, meaning they don't actively pick stocks, these firms end up owning a little bit of everything. And when you own a little bit of everything, you end up owning a lot of everything. Let me show you what I mean. BlackRock, Vanguard, and State Street are the largest shareholders in 90% of S&P 500 companies. Read that again. 90%. That includes Apple, Microsoft, Amazon, Google, Facebook, Tesla, Exxon, Chevron, JP Morgan, Bank of America, Pfizer, Johnson & Johnson, Coca-Cola, McDonald's, Walmart, and on and on. In many of these companies, they collectively own 15 to 20% of all shares. Now, 15% might not sound like a lot. But in a publicly traded company with millions of shareholders, 15% is enormous. It's enough to influence board elections. Enough to sway votes on executive compensation. Enough to push for or against mergers, layoffs, share buybacks, and environmental policies. And because these firms often vote the same way, their collective influence is even larger. But wait. It gets weirder. Vanguard is the largest shareholder in BlackRock. And BlackRock and Vanguard are both major shareholders in State Street. So these three companies own pieces of each other, and pieces of everyone else. It's a web. A very large, very quiet web. Now, to be clear, this isn't a conspiracy. It's a byproduct of the index fund model. When you own the market, you own everyone in it, including your competitors. But the result is the same, a historically unprecedented concentration of corporate ownership in the hands of three firms. And because most of that ownership is passive, they rarely make noise. They vote quietly. They don't issue press releases. They operate in the background. Which brings us to the uncomfortable question, if they control this much, what are they actually doing with it? And that is only the beginning. We've got a lot more to cover, and part 2 is where things get really interesting because we're tackling these three giants. If you're ready to keep going, the next part will be live soon. Click the subscribe button and also press the bell icon on the screen and let's stay updated. See you there.